Hey there, everyone, and welcome to the Final Bar. Happy Monday. It's August 12th, 2024. I'm your host, Dave Keller. I'm the Chief Market Strategist here at Stockcharts.com in a sunny but comfortably cool Redmond, Washington. Thanks for joining us every weekday after the close, especially today as we come out of the weekend, looking at how the markets have reacted today. To be honest with you, a choppy, sloppy day, but at the end of the day, no real change. The S&P 500, less than a point away from where we finished on Friday. You had a couple sectors finishing in the green, including technology, which is your top performer. But overall, I would argue the general sense that we talked about through the shows last week, sort of this primary downtrend with a brilliant counter trend rally last week. The evidence I'm looking at still sort of supports that general trend, but what can we learn by looking at the particular message of price and sentiment and trend? Let's get to our market recap and look at how the charts played out through the course of the day today. The S&P 500 finishing the day just around 53.44, a little slightly above there, but essentially no real change from Friday's close. We chopped around, opened a little higher, traded a little lower. By the lunchtime, we're sort of right back above zero, but settling in through the course of the day. The NASDAQ Composite outperforming slightly, but not by much, 35 points higher for the NASDAQ Composite to 16,780. The Dow remains below 40,000, down about 1/3%. That's your worst performer out of the three major benchmarks at the top here. But if you glance down a little bit, you'll see mid-caps down 0.7%, small caps down 1.25%. I feel like the small cap rally was short-lived, right? There was this period not too long ago. I felt like the great return of small caps. And, I did a webcast talking about small cap performance and general trends to look for. What would help support further strength in small caps and lower interest rates, generally speaking, tend to be pretty good for small cap stocks, smaller companies that need to borrow a lot of money to grow. But for now, it's certainly not working, right? The larger stocks are doing better, particularly coming out of that last week where you started to see that trend really reemerge. The VIX remaining comfortably above 20, but again, there's been a lot of noise in the VIX. I feel like the volatility of the VIX or the volatility of the volatility has been a little elevated here. The VIX still slightly above 20, and for me, 20 is one of those kind of basic back-of-the-envelope levels, right? And again, there's a lot more nuance and a lot more structure to a thorough market analysis, but I like to keep it simple just as a scorecard in my head, right? Is the VIX above or below 20? That gives you an initial reading on the general sentiment as defined by volatility and can give you an idea of where we're at sort of in the market cycle. Since the VIX spiked up to over 60, for only the third time since 2008. That was over the last 2 weeks. We've settled down quite a bit, but still elevated relative to where we spent most of the last 12 months for sure. Looking at interest rates, you can see the 10-year yield, 5-year yield, long bond yield all coming down today. The 10-year yield just around 3.9%. The 5-year point around 3.75. Bond prices, of course, moved slightly higher as interest rates came down today. It's interesting. We'll look at that stock-bond ratio, time permitting. Worth noting that bonds are actually a decent place to be, and it's been a long time since we've been able to say that. The dollar index as measured by the UUP, which is a bullish dollar ETF, not too much of a change. Commodities, a lot of green here. As a matter of fact, all green. You can see the broader commodity complex. We use the DBC for that, up about 1.4%. Gold, silver prices all moving to the upside. Gold and silver, again, showing remarkable strength. Copper prices higher, crude oil prices higher. So sort of that commodity super cycle thing is popping back in my head. That was a sort of general thesis we talked about at times over the last 12 months, looking for that reemergence. Gold at near all-time highs. Same for silver. Crude oil is the one that's obviously well below that, but starting to show some strength. And I think it's one of those if-then statements. If we get above $80 a share, that's when I think energy stocks start to look a lot more attractive. If we get even further, right, that sort of magnifies that as a potential new emerging source of leadership in a way we haven't seen in quite some time. Cryptocurrency is pretty volatile over the weekend. They did bounce from below 60,000 to above 60,000 over the weekend. Now, as we go through the equity market trading session, sort of in the upper 50K range, we did get briefly above 60,000, currently trading around 59,225 for Bitcoin. Looking at the 11 S&P sectors, you can see technology number 1 up 0.8%, energy number 2 up 0.5%, utilities number 3 up about 0.25%. The rest of the 11 S&P sectors all in the red today. At the bottom of the list, it's communication services, real estate, and consumer staples, all down over 0.5% today. You know, my market trend model I formally update over the weekend. No real change to the main market trend model that I use, which is using the S&P 500. And if you're new to the program or if you're new to Stockcharts, these are clickable links here. And if you click there, you can see the chart that I created to show the history of the market trend model. This is more of just a dashboard visualization, giving you a basic sense of where that model is at after every market close. Short-term model, bearish, has been for the last 3 weeks, I believe, and then medium-term and long-term still bullish. That medium-term trend model very close to turning negative, didn't quite do it last week, and obviously the big part of that was the market recovering through the course of the week last week really prevented that medium-term model from turning negative. But I do run the model on other ETFs like the NASDAQ 100, the QQQ, and it is negative right now for that medium-term time frame. Let's go to the Magnificent Seven and Friends, these leading growth stocks. I mean, these are key charts to watch, and I feel like if you want to know what is happening to the S&P or why we're seeing the moves that we are in the S&P or the NASDAQ, this group of 8 stocks is a good place to start because they represent the biggest names, they represent the biggest weights, and if these are doing something unusual, then our benchmarks are most likely going to be following suit. NVIDIA having a decent up day. Now let's remember that the general trend in NVIDIA, at least the tactical time frame of the last 4 weeks, has been clearly negative. We're in a clear pattern of lower highs and lower lows. Today, a nice move back to the upside, though, up over 4%. Apple, number 2, up 0.7% on the bottom. You have Tesla and Alphabet both down today. The rest sort of right around that zero level. Let's go to a daily chart of the S&P 500 and see how things played out today. So here's that, again, what I'm labeling as a counter trend move. And, that may be a completely wrong or a complete mislabel of the behavior, right? That could be the low from earlier in August. And this is just the beginning of a huge recovery. I just find that incredibly difficult to believe given all the other conditions that we've observed. And I think that's one of the great benefits of technical analysis and indeed the Stockcharts platform is you're not just limited to what you see on the chart of the S&P, although that's certainly where I would start. And that is where I do start every day, looking at weekly and daily charts of the S&P like the ones we've shown you here. However, if you really want to understand more deeply what is happening and what is, what are the conditions around the price movements that you see, that's where I think you go to breadth and sentiment, looking at sectors and ETF themes, looking at individual stocks that are on the move, and that can help you understand sort of the dynamics underlying the trend. I was looking at this chart over the weekend, getting ready for my weekly flight plan, which is my premium report for market misbehavior. Premium members noted the level 5,200, and I'm really just tagging the May low right here. As you look at what happened here over the last couple weeks, or the last 4 weeks, we peaked in mid-July. We came down to just below 5,200. I draw these horizontal lines because I like to think of the market movements as testing and retesting, of confirming, validating, invalidating certain levels. And that tells you generally where buyers are coming in or maybe where buying pressure is starting to improve and pushing price back to the upside. And it's worth noting we opened below 5,200 for one day and then pushed right back above there. And I think the move that we've seen over the last week is really just a strong bounce, but a bounce off of that level. How do you differentiate a very buyable pullback with something that is still in a primary downtrend? It's not a perfect science. I'd love to tell you this is the holy grail indicator you use and you'll never get it wrong. Any sort of financial analysis is wrong a lot. And anyone that tells you otherwise is lying to you or lying to themselves, in my humble opinion, because I've looked at a lot of different things over the years and nothing is perfect. Everything sort of, struggles in different environments or in different periods. And so it's all about money management. It's all about when you're right, staying right, and when you're wrong, staying wrong. So what are the reasons why we think it is a right decision or a right thesis to be, short-term bearish on stocks here? I would encourage you to literally get out of your chair, take a step or two away from your monitor, look at this chart of the S&P 500, and tell me what you think the trend is over the last 4 weeks. Clearly we're making a pattern after that peak in July of lower highs and lower lows, which means as a very basic premise, as long as that pattern continues, I would think of this market as guilty until proven innocent, meaning the primary trend is down until I see evidence that the primary trend is up. Go back to what you saw here at April and then into May, right? I think what are the reasons why you knew that this was now a nice recovery as opposed to the beginning of a big move downwards. I would say a couple things. Number one, we broke back above the 50-day moving average, which continued to slope higher, right? In a bearish phase, you will see things break below the 50-day, fail to get above the 50-day. The signs when we finally do get back above the 50-day, while not perfect, can often indicate, all right, at least there's enough buying power that's able to push us above that 50-day moving average. That tells me at least someone's interested in owning stocks here, and it's propelling the indexes higher. Number two, do we break above simple trendline resistance? And looking at the S&P here, do some real-time analysis here, and I'll probably redraw these, but just to give you a quick visual. You know, when you have a sell-off like that, I think it's good to just draw a trend line off of the major peaks here, right? So with one trend line, I can connect 3 or 4 of these levels. We see that lines up pretty well with late April when we finally broke above that trend line. Again, not a trading system I would use, but something that just tells me, hey, we were below this trend line. This was a consistent decline, and now we're actually changing that. You could draw a similar trend line right here. I guess you'd probably draw it up there, which says as long as we keep making lower highs on a bounce higher, as long as we remain below that trend line, as long as we remain below the 50-day moving average, I'm inclined to assume that that sort of primary trend is lower. But what's great about that is that gives you a clear set of signals, 3 things to look for, that would tell you we're probably in a recovery, right? We break above trend line resistance, we break above the 50-day moving average, we're able to make a higher high and ideally a higher low as well. That would be like final validation. If you look, like every major pullback, you can come up with those 3 general lines, right? Breaking above a trend line, breaking above the 50-day, making a higher high and a higher low, and that completes that rotation. You saw that really in November of last year. You saw that in May of this year, and I think when you see it here in Q3, Q4 of 2024, I will have no problem saying or suggesting that primary trend is now positive. But for now, all of those things are in the negative, which means at this moment, we'll continue to go lower. Let's go to a chart. Actually, I'm going to save that real quick so I don't have to redo that one later. Done. All right, let's go to, and by the way, that whole idea of drawing trend lines, of saving it, and this chart list, which is one that I use all the time, I would encourage you to have a chart list like this of your own. You're welcome to look at mine anytime you want, and hopefully watching the show, you get a sense of how I'm seeing things. Create a chart list on Stockcharts. First, you should have a login, and you should be a paid member, number one, but also create a chart list called macro charts or whatever and put the S&P and the NASDAQ and small caps and gold and interest rates, whatever you think are important to you. You can see the ones that are important to me on my Mindful Investor live chart list that I use every day on the show. Save things, draw lines on there, and then just keep saving those annotations. And literally this chart list will be an ongoing dialogue that you have with the markets, right? Think of charts as a conversation, your workbook to analyzing market trends and recognizing changes. That's what's so beautiful about doing this and drawing lines and even putting comments on the chart because then when something's different, you'll know, okay, I put this on here a week ago. This is what I was seeing. This is what I was thinking. Now it's a week later and XYZ has changed. Is that enough for me to change positioning? That's how I would generally use a platform like Stockcharts to improve your outcomes as an investor. All right, just briefly looking at the VIX here, and I'm doing this just on a closing basis. Remember, intraday basis, we got almost double that level, right? We got to 65 or so over the last week. But, we've settled down quite a bit, right? The VIX spiked incredibly high beginning of the previous week, but now actually we're coming down. We're still above 20. I mean, look at what the VIX has done in the last 2 weeks relative to what it did for the 12 months prior. When I talk about a change of character in the markets, when I talk about volatility popping higher, spreads widening, sentiment indicators shifting, which was a big topic that I covered on my own YouTube channel called Market Misbehavior, a couple videos last week on that, on the topic of market sentiment. It's all looking for conditions having a certain look and feel, and then something is different, what I call a change of character. I think the game as an investor is to watch things continue, watch trends persist, until they don't. Let the chart tell you when something is different. Let the chart tell you that the VIX is now in a new volatility regime. If you go back on my VIX chart for years, you'll find that I have these kind of horizontal levels where I identify certain volatility regimes, right? Sort of general ranges that the VIX has been in, certain character of the market that is defined by that phase in volatility. I would argue we are now in a period of higher volatility. And I think that was pretty clear back here in May, June when we're so consistently low. it tells you we have only one way to go, essentially, and that's up. And you're just waiting for that spike in volatility, which tells you things are different. This spike in volatility is much higher VIX-wise than we had in April of 2024, much higher than we had in October of last year. That's why I think this time certainly feels different in terms of the character of this market and how it's evolved. Now, other things have been changing quite a bit. I want to show the chart of interest rates just to illustrate the downtrend that we observed from the April market low, the April low for the S&P and the NASDAQ, May, June, July, all marked by a consistent trend lower in interest rates. But in the last couple of weeks, really in the month of August, we had a waterfall decline there as the S&P was selling off into early August. Then you had a bit of a bounce here. Rates can now come down over the last couple of days from the end of last week, now the beginning of this week. Certainly seems to me like that general trend still is negative, although we have had a bounce in rates. Similar reasons to what I cited for the S&P. The 10-year yield, $ TNX on our platform is still making lower highs and lower lows. I think as long as that persists, I assume that the trend in rates is still by definition lower. And that tells me to be looking for things that will probably do better when rates are going down. And that means bonds, by definition, right? Because higher bond prices lead to lower bond yields. Bond proxies, which would be low volatility, higher yielding stocks in the equity space, like utilities or REITs or maybe consumer staples. And generally speaking, small cap stocks tend to do quite well when you have lower rates because it's cheaper for them to borrow money, just like it's cheaper for you and I to borrow money to buy a car, buy a house, take a small business loan, whatever it is. This is the idea or the anticipation of the Fed starting to lower rates really sort of generally just makes things less expensive for individuals and businesses that need to borrow money to do stuff. And that is intended to grow the economy. So the market had been pricing in a perfect transition. I think what you've seen over the last couple of weeks is that becoming dislodged a little bit, and that incredible euphoric optimism that we saw for growth stocks in particular starting to wane. I think rates coming down, a part of that thesis for sure. I do want to show the stock to bond ratio. I can't remember the last time I've actually shown this chart on the final bar, not often because it doesn't change very much. And for years, in fact, it hasn't changed. This ratio has been firmly above its 200-day moving average for over 3 years. I mean, well off the left side, the viewable area here on the chart. This is just a simple ratio of the SPY versus the TLT. So it is the stock versus bond ratio. If stocks are outperforming bonds, this ratio is going up, which is what it has been doing for years and years and years. When the ratio starts to go down, which it just has done in a big way in the last 6 weeks, that means bonds are actually outpacing stocks. And what's interesting about that is that whole 60-40 allocation, which is a traditional allocation used by financial advisors, used by a lot of individuals, a lot of robo-advisors, kind of get you to that general point in the sweet spot of your glide path to retirement, as they like to say, 60% stocks, 40% bonds. Now, that particular allocation has not been quite helpful recently in recent years because the S&P has far outperformed bonds very consistently. Stocks have just done better. And so the bond part of your portfolio has basically hurt your returns, particularly as rates had been going up. Now the rates are coming down. Bonds are actually starting to make money again. Your bond mutual funds are not just money losers, which is what they've been for a couple of years now. They're actually generating a bit of income here as the returns are decent. I think that's something to certainly keep in mind. Getting defensive, I think, over the last couple of weeks has meant moving to bonds and bond proxies, and it really hasn't been the case for quite some time. I would keep an eye on this ratio, and again, I'm using the daily readings for the last couple of years. Look at a weekly chart for the last 10 years if you really want to understand that ratio and what a rotation may mean, because I think a lot of people have just come to the basic assumption that bonds are not a great place to be relative to stocks. We're now maybe, at least for now, entering a position where bonds are a decent bet relative to other areas that you could be in. I do want to just touch briefly on gold as well, and then we'll look at some individual stocks just to wrap things up here on a Monday afternoon in mid-August. By the way, as I'm bringing up the chart of gold, I'm going on vacation next week. We are going to Ireland for the first time, taking my family there for one last sort of summer holiday before we get back to school. So TBD on what we're going to do with this show next week. I'm actually working on, I think, some content that we'll be able to share with you while I'm on vacation. So we will still have a show. We'll have some great content to share. It might just be a different look and feel while I'm out. And then I'll look forward to being back in better than ever at the end of August. I wanted to show you the chart of the GLD, by the way. And if you look, I mean, I guess I would probably describe this as a coil pattern, a symmetrical triangle pattern in the chart of the GLD. If you look at the bounce that you had late June to mid-July, then we have the short-term pattern of lower highs and higher lows. And you can see we're just starting to break above the upper boundary of that coil pattern. That suggests if we can complete that breakout, if the GLT can get above 230, really implies much further upside from current levels. So keep an eye on that one for sure. Just to finish off here, looking at the market carpet, and again, I'm starting to really fall in love with this visualization. I love and proud of the development team for designing things with my feedback and others to make it a pretty powerful visualization. I'm digging the vanilla color scheme, but I would encourage you to check out some of the other ones because I think they're just different ways of visualizing it. And I don't think there's a right answer. I think the right answer is whatever is going to help you identify levels, identify outliers, find the names that you want to find using a heat map. That's the right answer. So for me, this vanilla one where neutral is kind of the beige color, up big is bright green, down big is bright red. That is helping me easily identify things that are moving, and I am so appreciative of that. Today, of course, it's NVIDIA, but if you look around, what I love about this is it's easy to find things like Starbucks and others that are just starting to pop higher. KeyCorp actually up almost 10% today. Still, sort of chopping around, but close to breaking to a new 52-week high after today's bounce higher. But I would also say one of the great things about this is to switch time frames. So look at the last month. And this is what a market pullback in 2024 looks like. The brightest red and the biggest boxes are one and the same, right? So these mega cap growth names down big over the last month is the story. But if you look outside, while those stocks have been going down and certainly pulling back, while our major benchmarks, the S&P and the NASDAQ, have been pulling back because they're dominated by those names, look at all the green. As a matter of fact, some of the bright green that has happened during that same 4-week period. That is the reality of, I think, the market environment here in August of 2024 is that the benchmarks and a lot of individual names are not in agreement. The benchmarks are driven by the mega cap growth stocks. If they're doing well, the benchmarks are fine. If they're doing poorly, the benchmarks are going to do poorly. I think it's a really good time as a stock picker to focus on actionable movements outside particularly of the growth sectors, because that's where you may find some of these more green boxes to hit on. A couple stocks to highlight today. NVIDIA, of course, one of your top performers in the S&P, up over 4% today. Now, that's a big market cap name, now about $2.7 trillion in market cap. Overall, the setup may be very compelling. I'll go back to what I told you about the S&P. Look for breaks above trend lines. Look for breaks above the 50-day moving average. Look for a higher high and or a higher low, which means, to be honest with you, NVIDIA needs to get above 120 before all of those things would be crossed off. That would be above the 50-day, above a trend line, probably making a higher high, maybe a higher low between now and then. Until then, I'm inclined to think of NVIDIA as still sort of in a downtrend versus an uptrend. Public service announcement. When people ask me about a chart like Etsy and what to do with a name like this, my first answer is I wish you would go back and look at all the clear signs of a chart in a very powerful downtrend, right? Stocks below downward sloping moving averages, in my process, are to be avoided, because what it tells you is there's just not enough accumulation happening. Stocks go up because they are being accumulated, generally speaking, by money managers, by big investors that have a lot of capital to allocate and are putting bets in big names, right? The more and more demand there is to own an Etsy, the more the price is going to go higher, and the more the brokers are going to fill you at a higher and higher level because they're able to get that out of you to buy into the stock. And that feedback loop often causes prices to go onward and ever upward, as it were. A chart of Etsy continuously below a downward sloping 200-day moving average for most of the last year and a half is the type of chart that I think you wait on. And when we think about the message of higher highs and what it means to eclipse a previous swing high, this is exactly why we do that comparison. The June peak around 66 was not eclipsed in mid-July, was not eclipsed in late July. Now we're making a new 52-week low, but I think that is just continuing this trend that has been clearly negative for quite some time. Let's finish on a high note. I don't want to finish with the chart going down. Let's finish with a Monday. It is Monday, and Monday.com MNDY making a new 52-week high today. Think about what we saw on the chart of Etsy, right? Resistance tested, failed. The chart of Monday, resistance tested, resistance eclipsed as we break out 15% higher today. This is an earnings name today. And again, I don't think you necessarily need to know everything about what a company is doing in their earnings report. I think it's good to know things about valuations and the earning trajectory of a company over time, and recognizing that stocks do trade to their fundamental valuations, I believe, over a period of time. But in the short term, in the medium term, it is much more driven by investor behavior and sentiment. Charts can be a beautiful window into the reality of sentiment shifts. I would say the sentiment on Monday, pretty bullish here on a Monday afternoon. Folks, that's it. That's a wrap for today's show. Thanks so much for joining us every weekday after the close for the Final Bar. Have a great one. Have a good night. We'll see you tomorrow.